how the impending crash of the dollar will be. The claim that the US currency has no alternative makes little sense. Humiliation has long been piling up against those who dare to question the superiority of the US dollar as the world's dominant reserve currency. In reserve to a column I recently wrote for the Bloomberg Opinion on the possibility of a sharp drop in the US dollar, I definitely got more than I am. The counter-arguments were strong and highly political, based mainly on the so-called TINA defense. As far as the dollar is concerned, there is no alternative. This argument is crucial in a critical sense. The dollar is a relative price like any exchange rate. As such, it encompasses a broad set of a nation's value proposition, economic, financial, social, and political, compared to comparable definitions of other nations. As a result, changes in exchange rates capture changes in these relative comparisons: USA versus Europe, USA versus Japan, USA versus China, etc. My prediction that a 35% decrease in the value of the dollar could occur is expressed in terms of a comparison between the US and a large basket of American trading partners. The individual components in this basket are weighted by their US and country-specific trade shares and expressed in real terms to capture varying inflation differentials. As an economist, I care most about the currency-related changes in international competitive power. The real effective exchange rate, or REER, calculated monthly by the Bank for International Settlements, is particularly well suited for this task. When examining the TINA critique of the weak dollar estimate, it helps to begin with the weighting structure built into REER to understand which of the 58 country-to-country relative comparisons that strain the BIS structure might be most important. The percentage of the broad dollar index is lower. Based on cross-border manufacturing trade flows, BIS assigns the largest weights to China 23%, Euro area 17%, Mexico 13%, Canada 12%, and Japan 7%. These 5 countries, zone in the case of the Eurozone, account for 72% of the total trade weight in the broad US dollar index. Additionally, 13% come from countries 6 to 10, South Korea, United Kingdom, Taiwan, India, and Switzerland. The weights of the top 10 make up 85% of America's cross-border trade. On this basis, a weaker dollar forecast requires some strengthening of the renminbi and euro in China. The currencies of America's USMCA partners, formerly NAFTA, Mexico, and Canada, are also important in that they make up 25% of the US manufacturing trade. The yen is of little importance anymore for movements in the broad dollar index, given the sharply lower trading weight. The Chinese call is very contentious. From the trade war to the coronavirus war to the possibility of a new Cold War, the adverse situation for China has never been stronger in the US than it is today. Despite these concerns, the wide renminbi index generated by BIS rose 153% from December 2004 low in real effective conditions. As China continues the structural reform process that shifts from manufacturing to services, investment and export-led growth to consumer-led growth, and embraces greater liberalization of its financial system, more money value means essential, even in the face of an increasingly strained relationship with the United States. The call to the euro is unreasonable, especially to a broad consensus of innate Eurosceptics like me. This goes back to the days of Morgan Stanley, where I argued that an incomplete monetary union, particularly the lack of a pan-European financial transfer mechanism, could not withstand the inevitable stress of asymmetric shocks. Now I must admit that reports of the euro's imminent death are greatly exaggerated. Europe has repeatedly adapted to this situation, especially in the last 10 years, and prevented the disastrous collapse of the seemingly dysfunctional monetary union. From Mario Draghi's promise to do whatever it takes to save the euro from an independent debt crisis in 2012, and end to the 750 billion euros, which is $855 billion, Next Generation European Union fund to address the coronavirus crisis, Angela Merkel, Emmanuel Macron, the European experiment faced extraordinary difficulties, with a trade-heavy euro 15% below its April 2008 high. There is a clear upside for the world's most unpopular currency. While China and the Eurozone make up 40% of US trade, I am the first to admit that the mathematics of a dollar collapse will not add up as I expected, unless these two currencies increase significantly. Moreover, as both economies grapple with the long-standing current account surplus, though it has declined sharply in China in recent years, the appreciation of money is the classic treatment of such imbalances. Movements in other currencies should reinforce this result. This is especially true for the yen, where Japan should have support from the relatively successful COVID-19 containment strategy. The same can be expected from USMCA partners Mexico and Canada, whose currencies were hit hard earlier this year due to the deadly combination of the coronavirus shock and a dramatic collapse in world oil prices. The fall in peso was exaggerated by the loosening of the so-called move transactions during the US stocks meltdown in late March, preventing a double-bottom recession in the global economy. The paradise where the dollar plays should relax on the balance of 2020 and 2021, which should reinforce the negative state of the dollar, while cryptocurrencies and gold should take advantage of the weakness of the dollar. These markets are too small to accommodate major adjustments in world currency markets, where daily turnover is around $6.6 trillion. Unfortunately, the Tina argument doesn't stop there. It also rests on the reserve status of the US currency as the cornerstone of the world financial markets against my situation regarding the weakness of the dollar. All trading countries must hold the dollar as the price of doing business in an increasingly integrated dollar-based world economy. Even so, according to BIS, the dollar's share in official foreign exchange reserves has dropped from just over 70% in 2000 to just under 60% today. This downward trend could gain momentum in the coming years, especially with the US currently leading the way in globalization and segregation. Such a correction might well be inevitable in an increasingly fragmented, multipolar world, given that America's share of reserves is well above its share of the world GDP and trade. If Tina is the only hope for the dollar, see below, America's savings and current account problems come into play with vengeance, and the rest of the world is starting to look less bad. Yes, a weaker dollar could increase the competitiveness of the United States, but only for a while. Despite the arrogance of American exceptionalism, no leading country has devalued its continual prosperity. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.